Unlock your potential with a comprehensive suite of investing tools and expert education with GammaEdge. Start your free 14-day trial today. You really have four things to do. You can sell to open, and sometimes you'll see in the literature that's called STO. So I could take a call and I could sell it. So STO, a strike, and now if I'm selling it to open, I'm short that particular option. And I could BTO, which is, of course, buy to open. So I'm long. So those are my two opening ways of establishing open interest in the chain. And the open interest in a chain outside of GammaEdge doesn't make any references whether the opening strike is bought or sold. Open interest is an absolute value. It's a positive number always. And so it's the combination of both short interest as well as long interest at that strike. So when you open up an option chain and you look at that, you'll actually see that that positive number. Now, to close that option, if I sold to open, STO, so my position is short, I need to buy to close. And so I would place an order that would buy to close. And most brokerages allow you to select the different combinations that we're discussing here. So an STO to close it would be BTO. And if I was BT buy to open, then I would sell to close, STC, and effectively that's how I get out of the position. Now you're absolutely right. You can be assigned. And so in options in general that trade what is called, there's two forms of options. There's something called the American style, and then there's a European style. European style is the SPX. It's also the NDX, the VIX, and these are index options, and you cannot be early assigned. So it's the date of expiry that the option, if you go to the end of the day, they'll either be fully in the money or they'll be worthless. And so exercising a European style option is something you would want to do generally if you had any uncertainty about whether you were going to be in the money or out of the money, profitable or not profitable. But there is no assignment. There's no early assignment, I should say. And so at the end of the day, if you just let it lapse and it's profitable, you'll wake up the next morning and your bank account will be fatter or smaller, depending on if it was a loss or if it was gain. That's the way that works. That's cash settled. Most equities in the United States, in the standard markets, are American style options, and you initiate a BTO, a buy to open, or a STO, sell to open, and then you have to transact it generally unless you want to be assigned if it's in the money. Now what that means is that if you were to go into Apple, and I don't know what Apple closed at today, but let's look. Did Apple do? Apple is somewhere around 182. So that represents 100 shares of stock control. So for Friday, it's got weekly options. If you bought a long call in this particular one, you would, and say you bought the 180 call, and now it's at 182. You're in the money $2.84 as of today. If it remains above that 180 and you do not close it by Friday, then you will wake up, provided you have the account monies have the monies in your account, you will wake up Saturday morning, the proud owner of 100 shares of Apple with a cost basis of whatever your strike was. And in this particular case, it'd be 180. Of course, I'm ignoring commissions and all that stuff. And, you paid a premium, so actually higher, all of that stuff. Those are all the asterisks on transactions. If it finishes at 179.99 Friday night at late settlement, et cetera, all that being what it is, you would be out of the money and your call would be worthless and you would have lost your premium. And that's just the way that part works. Now, if you sell to open and you got a credit, maybe you wanted it to be out of the money, and maybe you wanted just to pocket all of that difference. and that would be a viable strategy. That's where options are so powerful here, is that depending on what you want to do and what your thesis is on the stock, the ETF, or the index option, you can construct a trade that is far more superior in risk and far more superior aligned with what your objectives are compared to just owning the underlying stock. So there is a scenario that I didn't go into. You don't have $18,284 or 18,000 actually, because they would want to give you the 100 shares at the strike price. You don't have that in your account Saturday morning. You wake up Monday morning and you find you've got a margin call, and what that basically is saying is you're in trouble because you were basically bigger than your shoes allowed you to be, and so you either got to deposit money or they will liquidate other positions in your account at their discretion, not yours, to come up with the money to assign you this money, or to assign you these 100 shares of Apple. So this is why you typically want to make sure you absolutely know how to transact the opening and closing of an option and not let it go to expiry, because if you let it go to expiry, depending on the moneyness, you may end up a proud owner of shares that maybe you don't want. Now, you could turn around and say, I just want to, assign me and I'll sell them the next day. But if Apple gaps down on Monday to 175, you're the proud owner at 180. And now you got to unload those at 175 and you're going to take a $500 hit. So you don't want to do that.